Welcome back to our series on basic accounting principles. So in our last video we talked a little bit about the balance sheet, one of the most important reports that a business owner can use to analyze their business. We also talked a little bit about the accounting equation. And if you remember from our conversations, the accounting equation is assets equals liabilities plus equity. So this equation encompasses all possible transactions that a business could perform in their accounting software. But you'll notice that from our conversations previously about the profit and loss, those transactions don't appear to be here just looking at it from a broad view. Where are our income? Where is our expenses? Those things look like they're missing. But actually, they're all contained within this equity section. So assets is pretty straightforward. It's our stuff. Liabilities are pretty straightforward. That's our debts. But this equity section, there's a lot to it that we didn't really cover when we talked about balance sheets, just for lack of time. So I wanted to cover that in a separate video today and make sure we have a good understanding of what goes into equity. So let's take a look at that. So in our equity section, equity, as you recall, is just our net worth of everything in the business. It's what the owners own in the business. So if you were to treat the business like an investment, this is the investment value that owners like to track. And that's why this equity section is so important to owners, and they track it very closely. So we want to make sure we understand it, we know how to use it, we know how to analyze it. So equity has several different accounts. One of the most important things that we want to track in equity is how much of the equity the owners are putting in or taking out. So we have some accounts for contributions that the owners make and also distributions that the owners make into the business. Just like if you were to work with an investment, you'd want to know how much money you're putting into it and how much money you get to take out of it. That's important. Depending on the type of legal entity that your business is, the names for these accounts might be different. You might be calling these capital stock and additional paid-in capital. You might be calling them contributions and distributions. There's, your naming conventions might be different, and how you structure them and use them may be a little different. So you'll want to make sure that you check with your accountant about how you've set up your equity accounts and make sure that they're set up correctly for your specific entity type. Because there's so many different types of entities, we're going to keep this pretty simple and just stick to basic concepts. But you'll want to check with your accountant and make sure that you're setting yours up correctly for your specific business. So we have our contributions and our distributions from our owners. In addition to that, equity is also the section where we have net income. So this is where our profit and loss comes in. We have our income and we have our expenses all built into this equity section. And that's where they're being stored. Because in the end, net income is the net earnings of the business. They belong to the owners. And so that gets stuff here in the equity section because it's really part of the owner's ownership in the company. Now, that's just the net income for this year. It doesn't cover any of the prior years, but we want those prior years on there as well, or the balance sheet isn't going to balance. All transactions must be in the balance sheet, or it will not balance. So, for all of our prior year net earnings, some of those net earnings are going to be distributed out to the owners. That's part of this distribution section here. But some of those net earnings are going to be kept in the business accounts or retained in the business to be able to use to pay off debts and to expand and grow as a company. So any of those net earnings that are retained in the company are put into a special account called, no surprise, retained earnings. And all that is any of the leftover earnings from prior years that are kept inside the business. And so you'll find that we will have all of these different categories split out throughout the year so that we can monitor these different categories that are important to us, like how much the business is earning and how much the owners are putting in or taking out. But at the end of the year, on December 31st, if we're a December 31st year-end close, on December 31st, all of these accounts get closed out and rolled into retained earnings. Or in other words, they get zeroed out and all of their value moves to retained earnings. And then the next year starts with net income, contributions, and distributions at zero. Throughout the year, those accounts will grow, and then on December 31st, all of the value of those accounts are moved or rolled into retained earnings, and the cycle starts again. And so if you want to see the value of prior years, that's all contained here in this retained earnings account, and all of the other accounts show things that affect equity for just this year. Now, as I mentioned before, the naming conventions of retained earnings, contributions, distributions, those may change depending on the entity type that you have, but the concepts will always be there. And that's what is equity, and that's what equity contains. And hopefully now you have a little better understanding of what goes into that, because it will be very important as we move on to our next video, which is handling debits and credits.